Welcome back to the channel, everyone. If you're new here, I'm your name, and today we're diving into one of the most important, but often misunderstood, topics in personal finance, risk tolerance, and asset allocation. Most people think investing is all about picking the right stocks. But in reality, the real success comes from understanding yourself, your goals, your time horizon, and how much risk you can truly handle, and then building a portfolio that matches you. Stick around for the full video because by the end, you'll know exactly what risk tolerance really means, how to figure out your own risk level, how asset allocation works, and how you can build a portfolio that grows with you, not against you. Let's get started. Section 1. What is risk tolerance? So first, what is risk tolerance? Risk tolerance is basically the amount of volatility or up and down movement that you can emotionally and financially handle in your investments. Think of it this way, if your portfolio suddenly dropped 20%, would you? Buy more because you know it's temporary, B, do nothing, and ride it out. C, panic, sell everything, and swear off investing forever. Your answer says a lot about your true tolerance for risk. 3 components of risk tolerance. 1. Emotional tolerance, how you feel about losses. 2. Financial capacity, how much loss you can handle without harming your lifestyle. 3. Time horizon, how long your money can stay invested. Quick example. 2 investors are both 35. Investor A has a stable job, good savings, and invests for retirement 30 years away. Investor B is a freelancer with inconsistent income and may need money in 5 years. Even though they're the same age, Investor A has much higher risk tolerance because they have stability, flexibility, and a long time horizon. Section 2. Why risk tolerance matters. Here's the truth. If your investments are too risky for your personality, you'll panic sell during downturns. If they're too conservative, you'll struggle to grow wealth long term. Both scenarios hurt your financial future. Risk tolerance helps you decide which investments you can stick with through good times and bad. Everything we cover next, asset classes, portfolios, diversification, all starts with this one principle: know yourself before choosing investments. Section 3. 3 types of risk profiles. Let's break risk tolerances into 3 common profiles: conservative, moderate, and aggressive. 1. Conservative investor prioritizes preserving capital. Dislikes volatility, often near retirement or with short-term financial goals. Prefers stable investments like bonds or cash equivalents. These investors don't mind slower growth if it means more stability. 2. Moderate investor, comfortable with some volatility. Has medium to long time horizons, wants balance, growth, but with some stability. Splits investments between stocks and bonds. Most long-term investors fall into this category. 3. Aggressive investor, can tolerate big market swings. Has long-term goals 20 years, prioritizes high growth. Invests primarily in stocks, especially growth sectors. But remember, aggressive investing only works if you have both the financial and emotional stability to stomach volatility. Section 4. What is asset allocation? Now that we understand risk tolerance, let's talk about asset allocation, which is how you divide your investments across different asset types. Think of asset allocation as your investing blueprint. It determines your potential returns, your level of volatility, your risk over time. Main asset classes. 1. Stocks, equities, high risk, high return potential. 2. Bonds, fixed income, lower risk, steady income. 3. Cash or cash equivalents, very low risk, low return. 4. Alternative investments, real estate, commodities, crypto, etc. Why asset allocation matters? Studies consistently show that over 90% of long-term investment performance comes from asset allocation, not from picking individual investments. It's not about finding the perfect stock. It's about building the right mix for your goals. Section 5. Matching risk tolerance to asset allocation. So now let's match these ideas together. Here's how asset allocation can look depending on risk tolerance. Conservative portfolio example. 20% stocks, 60% bonds. 20% cashy stable investments, low growth, high stability. Moderate portfolio example. 60% stocks, 30% bonds. 10% alternatives, balanced risk and return. Aggressive portfolio example. 85% stocks, 10% bonds. 5% alternatives, high growth, high volatility. Why these mixed differences matter? Let's say the market drops 20%. The aggressive investor might lose 15 to 18%. The moderate investor might lose 10 to 12%. The conservative investor might lose only 4 to 6%. This difference determines whether an investor panics or stays the course. Section 6. How to assess your own risk tolerance. To figure out your personal risk tolerance, consider these questions. 1. What's your time horizon? Longer time horizons can handle more risk. 2. How steady is your income? The more consistent your cash flow, the more risk you can take. 3. How did you feel during past market drops? Did you panic or stay calm? 4. What are your financial goals? Long-term goals equals more risk. Short-term goals equals less risk. 5. How much investing experience do you have? New investors often underestimate how real volatility feels. Tools that help: online risk assessment quizzes, financial advisor consultations, portfolio simulators that show how your investments might perform in downturns. Section 7. Time horizon and life cycle allocation. As you age, your risk tolerance usually changes, and so should your asset allocation. General guideline: the longer your money can stay invested, the more risk you can take. Life stage examples: early career 20s, 30s. Income is growing. Long time horizon, typically high risk tolerance. Portfolios may be 80 to 90% stocks. Mid-career 40s, 50s. Balancing growth with stability. Portfolios shift to 60 to 70% stocks. Pre-retirement 55 plus. Protecting principal becomes a priority. Portfolios might move to 40 to 50% stocks. Retirement, focus on income, not growth. 30 to 40% stocks, more bonds and cash. Section 8. Rebalancing and staying on track. Even the perfect asset allocation will drift over time. If stocks perform well, they can take up more your portfolio than you intended. That's why you need rebalancing, adjusting your investments back to your target mix. Most investors rebalance once a year, or when allocations drift more than 5 to 10%. Rebalancing forces you to sell high and buy low, the opposite of emotional investing. Section 9. Common mistakes to avoid. Before we wrap up, here are the most common mistakes investors make. 1. Ignoring their true risk tolerance. If you panic during downturns, you're taking too much risk. 2. Investing based on emotions. Fear of missing out leads to over-risky portfolios. 3. Chasing past performance. Just because tech stocks ran last year doesn't mean they will next year. 4. Not diversifying. One stock is not a strategy. 5. Never rebalancing. Portfolios drift, and risk increases without you realizing it. Alright, now you know exactly how to figure out your risk tolerance, how asset allocation works, and how to build a portfolio that actually fits your financial life. If you found this helpful, make sure to hit that like button and subscribe for more weekly videos on personal finance and investing. Drop a comment below. Are you a conservative, moderate, or aggressive investor? I'd love to hear your take. Thanks for watching, and I'll see you in the next one.